Good evening and welcome to our 2025 third quarter financial market update call at Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call AI Everywhere. The call tonight is being recorded and will be on our website, greatlatesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the third quarter and what we see going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets. Take it away, Pat.
Thank you, Dan. This is Pat Patin, partner and portfolio manager at Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we'll be providing is from sources we believe to be reliable. There's no assurance that the information is accurate or complete. This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It's not designed for or individually tailored to any particular investor and not intended to be suitable or in the best interest of all types of investors. Opinions expressed in this presentation are subject to change without notice. There is no guarantee that any forecast made will be realized. Today, I want to walk you through where markets stand year to date and how the economy is taking on what I call a K-shaped economy split. Cover what that means for asset classes over the next 3 to 6 months, highlight opportunities we see for a potential rally, and also point out important risks to keep on your radar. As always, nothing here is a guarantee, but rather our view of probabilities and how we are positioning in your portfolios. I'll begin with a quick recap of performance across major asset classes so we have the backdrop. The year-to-date price return for the S&P 500 is up 17.2% as of October 28th. The Dow Jones Industrial Average is up 12.1%. The Russell 2000 Small Cap Index is up 12.4%. The NASDAQ Composite is up 23.4%. International stocks represented by the EFA index are up 26.6%, and gold is up 50.5% for the year. Bonds represented by the Bloomberg Aggregate Bond Index total return are up 7.2%. Taken together, this is a somewhat favorable backdrop for risk assets. Equities are holding up, bonds are offering yield, diversification is working with gold and international stocks outperforming. Tonight, I want to talk about what's happening in the economy right now and why people keep using the term K-shaped economy. It's an easy image to understand. Imagine the letter K. You got one leg of the economy is going up, the other is going down. And that's what we're living through. Some groups and businesses are thriving while others are falling behind. Let's start with what's driving this divide. As Dan will cover in more detail later, the latest inflation report for September showed prices rising 0.3% for the month, 3% over the past year. That sounds better than what we were seeing a year ago, but the details matter. Prices for food, rent, and everyday essentials are still rising faster than people's paychecks. Some call this the perfect K-shaped economic report because higher income families are coping fine, while lower income families still feel squeezed. Spending tells the same story. Moody's Analytics recently reported that the top 10% of earners now make up about half of all U.S. consumer spending. In other words, 1 out of every 10 households is driving half the country's purchases. That top group has increasingly spent by roughly 12% in the last year, while middle and lower income families have pulled back. They're eating out less, they're buying fewer extras, and they're looking for deals. It's not that the economy isn't moving forward, it's just moving faster for some people than others. Businesses are seeing this split too. In recent earnings calls, several restaurant chains said premium and luxury items are selling well, but value menus are still getting more traffic from customers trading down. Airlines say first class, business class seats are in high demand, while budget travelers are cutting back. These are all signs of the same thing, a two-speed economy. The divide isn't just about spending, it's also about jobs. If you're on our screen right now, you can see I'm showing a pretty striking chart there. It's from a study of companies that have started using artificial intelligence in their daily operations. After AI tools like ChatGPT 3.5 came out, hiring for junior positions dropped at those firms. Senior roles stayed about the same or even grew. At companies that haven't adopted AI, their junior jobs didn't fall nearly as much. So technology is giving experienced workers more leverage, but making it harder for younger or less experienced workers to get started. The researchers call this seniority biased technological change, which really just means AI is helping those who already have the skills while limiting openings for those who don't yet. This shift has consequences. When fewer people are getting entry-level jobs, it affects spending, confidence, and even family finances. Jim Bianco, a well-known market researcher, pointed out that the bottom 60% of households in America now hold almost no financial assets. That means when prices rise or hours are cut, they have very little cushion. For many of these families, the monthly budget still feels tight, even though inflation headlines look better. Meanwhile, at the top of the K, the story is completely different. Wealthier households own most of the stocks, real estate, retirement accounts that have recovered since the pandemic, and they're benefiting from higher interest rates on savings and from corporate profits tied to technology and automation. According to analyst Steve Ratner, investment in artificial intelligence related products made up about 31% of all the US economic growth in the first half of the year. Without that AI investment, growth would have only been about 1% this year. That shows how much of the momentum we see today is coming from a small part of the economy. So when you hear the market is strong, it's important to remember that it's being carried by the upper leg of the K, by companies, consumers who are still spending freely. For millions of others, things feel very different. It helps explain why public surveys show people feeling negative about the economy even while the stock market is near record highs. Both are true at the same time because they describe two very different experiences. The K-shaped economy helps make sense of the mixed signals we're all seeing. Corporate earnings can look good even as many families tighten their belts. Job reports can look healthy even as new graduates struggle to find their first opportunity. And markets can climb because the people who own investments are, for the most part, the same group that's doing well in this split economy. As investors, the takeaway isn't panic, it's awareness. The economy isn't broken, but it is uneven. Some sectors, companies, and households are positioned to grow, while others are fighting to keep up. Understanding that divide helps explain why markets behave the way they do and why sentiment can seem out of step with the numbers. In the next part of the call, Dan will talk about what it means for the financial markets and where we see opportunities and risks going forward. But the main point I want to leave you with is this. The US economy today is not moving in one direction. It's moving in two. The top of the K is still climbing, and the bottom is straining to hold on. Knowing which leg you're on and investing accordingly makes all the difference.
Thank you, Pat. Let me start with a summary of what I shared during our last call in July of 2025. If you remember, I titled our last quarterly call, Is the Smoke Clearing? And I'd like to start by summarizing what I said in July and what has happened since. The metaphor of smoke and fire I use to describe the financial markets. While some areas are clear and more constructive for investing, others remain uncertain and require close monitoring before we declare the all clear. Where do we have the clarity? The tax bill, major positive. All of the 2017 tax cuts have been made permanent. Corporations can now deduct 100% of capital expenditures, plant, equipment, machinery, in the year they were incurred rather than over 10 to 15 years. Corporate tax rates have been fixed at 21% permanently. The provisions for planning and visibility have strongly incentivized business investment. This is a major long-term positive for corporate earnings and the stock market. On the area of the tariffs, we've had some progress, but the outcome is still incomplete. We've deals signed with Japan and the EU, negotiations ongoing in Mexico, Canada, and China. Inflation's impact from tariffs has been minimal so far. As I said, the April CPI was up 2.3, May 2.4, June 2.7. Companies are mitigating impact via advanced purchases, absorbing costs, adjusting prices cautiously to avoid losing customers. Now, the tariffs do continue to be an overhang, and how we know that is whenever the president starts talking about them or changing them, the market has tended to react negatively or positively, depending on what he is currently saying. I mentioned my caution in July on interest rates. Remember, the Fed has a dual mandate: stable prices and inflation, and stable prices, that's inflation, and stable employment. Despite slowing growth, the Fed had been holding off rate cuts until the tariff inflation effects were clear. The 10-year Treasury yield in April was 4.4. July, it was 4.42. The risk was the Fed waiting too long and the slowdown, could deepen. Now, we also know that Chairman Powell's term as chairman of the Federal Reserve will end in May of 2026. I mentioned he'll probably be replaced by a more dovish chairman who would probably support future rate cuts. The current economic environment in July was payrolls up 147,000, unemployment 4.1, and that was the weakest job growth we had seen year to date. Housing softer, the dollar down 6.7% year to date against other currencies. And again, that affects corporate earnings negatively. Now, in July, we had extreme greed. And in April of last year, when we had the Liberation Day, as many called it, when President Trump announced tariffs, we had extreme fear. July, we got overbought. And again, we thought, okay, we needed a little bit of a pause in the market. Interpretation at that time was, again, that was probably a little bit negative in the short term, but I mentioned that investors are getting wiser about not selling at the bottoms. We mentioned about the benefits of the 50-day moving average being over the 200-day moving average. That went positive July 1st. And historically, whenever the 50-day moving average is above the 200-day moving average, we see a historical return of 9.06% annualized for the S&P 500. When it's below, it's only 0.59. Now, with again, July 1st, the S&P was 6198 at that time. So that was an important reversal I mentioned and a very positive indicator for the market. So again, my summary and outlook in July was we get more clarity, benefit of the tax law, potential for Federal Reserve rate cuts, technicals in the market were getting positive, and we said any short-term weakness in the stock market would be seen as an opportunity for us to add to our positions in the market. I said Great Lakes Private Wealth remains bullish long-term. Since last July, the market's up almost 11%. So that was very, very accurate. So in summary, our outlook was pretty darn accurate of what we thought was going to take place. Now, with the third quarter behind us, what matters is what we see going forward for the fourth quarter, as well as what do we see for the first quarter of 2026. Tonight, we have a special guest with us. Clients that have been with us for a long time know we've utilized Ned Davis Research for over 10 years. Tonight, we have Ed Clissold, is Ned Davis's Research US Chief Market Strategist. He holds the esteemed CFA charter and has a master's in finance from the number 2 rated college football team in the country. Who would that be? Indiana University. And I have to say, Indiana being the number 2 team in the country doesn't happen very often, so we need to mention that for his benefit. You may have seen him on CNBC or read him quoted in the Wall Street Journal or Barron's Magazine. Ed's going to share with us a few key things they're watching at Ned Davis Research as it relates to the economy and the direction of the market. Good evening, Ed.
Thanks, Dan. Appreciate the introduction, and of course, I'm always glad to get some Hoosier love after 25 years of trying to get past Bobby Knight unsuccessfully. I guess we're trying a new sport here. Seems to be working out well so far, but that's not what you came here for. Let's talk market. So, what is it we do things at Ned Davis Research is we really try to take the emotions out of things and talk about the data. We have over 10 million data files in our system. We have our own software that we wrote to analyze the data. So when you see an NDR chart, it's a very unique look and feel to it. That's by design. We want you to know it's an NDR chart, but there's a lot of statistical work that goes on behind the scenes to ensure that an indicator is fairly robust. Of course, there's no guarantee something's going to work in the future, but if you test it enough different ways, it's robust enough to think you have at least a decent chance. And if you look at a bunch of different indicators in conjunction with each other, that would also increase the chances of being on the right side of at least the major moves. So we're going to go over a few things here. First, we'll talk big picture macro. The big thing going on this week is the Fed is going to meet on Wednesday. We're recording this on Monday, almost assuredly going to cut. And there's two reasons for that. One is the labor market is certainly softening here. There's some questions of whether or not it's because the economy is really weakening, because some of this has to do with immigration reform. There's just fewer people coming in the country. That's a political decision. Don't want to comment on that. But from economic perspective, it means there's fewer jobs being created. But does that matter? Is the Fed going to affect that? Probably not. We also have an effect of young workers are having a tougher time finding jobs. Some of this is because of AI, particularly young computer science grads. All those kids we're told, go do computer science. Well, they were better off like studying humanities, being a philosophy major, than cranking away coding for the last 4 years. But we've seen a 2 percentage point drop in the labor force participation rate by younger workers. And so part of that is AI. For sure. And then the third thing is that companies are actually managing earnings by slowing their hiring pace to offset the higher costs from tariffs. So we are seeing some tariff inflation coming through, but companies are managing around that. That's helping profit margins, also keeping inflation down, which brings us to the second point. Even though inflation is above the Fed's mandate of 2%, that's their long-term objective, it's still kind of moving the right direction. And that's what this chart is showing. So the top section shows the S&P 500 index, the broad benchmark for stocks. The bottom section shows the year-to-year change in the CPI, Consumer Price Index. And then when the CPI falls below a 6-month average, that's disinflation. And that is actually where we are now, and we have been since August of 2022. In fact, if you said, hey, Ed, give me one chart that describes the last 3+ year bull market, this would be it. Inflation peaked, and it's been rolling over ever since. It's gotten close to reversing higher, but hasn't quite gotten there. And we're going to be dropping some low numbers over the next few months. So it's very unlikely this is going to turn bearish for stocks in the near term. So this also gives the Fed cover to cut rates. Now, when the Fed does cut, that's a nice tailwind for stocks. Sorry, little struggle getting the charts to move, but here we go. Okay, so what this chart is showing is what the market has done once the Fed has resumed easing. So they cut a few times toward the end of last year, and then they didn't cut again until September. And so what the blue line here is showing on average what the S&P has done when the Fed has had these long pauses. That dashed vertical line is the end of those pauses. So I find it really fascinating. If you look at the orange line, which is what's happened this cycle when the Fed's cut again in September, we actually had that correction about the time we normally do when everybody's worried about, well, the Fed had to stop cutting rates because they're worried about inflation coming back. The market doesn't like that. But then you get, about 3 months before the Fed starts cutting again and they start talking about easing, and the markets start to price in that good news. Now, afterwards, stocks generally continue to rally, not as strongly as they did the few months before, but it's a nice tailwind from the Fed. for them to be able to keep to resume their easing cycle. Okay, so one more thing on the economy here, trade uncertainty hasn't gone away. There's still a lot of details to be worked out, but as the Trump administration gets broad stroke deals done with more and more countries, I would expect that uncertainty to fade from an investment standpoint. And I think we've already seen a lot of that, talks of the so-called taco trade. Trump always chickens out, which probably is, it's a nice acronym. I'm sure it's completely descriptive, but generally speaking, the administration wants to get things in place so that the economy can move forward. Now, what this chart is showing is how the economy reacts to when there's lots of uncertainty. So that orange line in the middle, this is the Federal Reserve Economic Policy Uncertainty Index. Mouthful here. What they're doing is they're looking at online articles and scraping them for keywords that imply economic uncertainty. Not surprisingly, this hit a record high in April, right around the time of the Liberation Day announcement. It's been coming down, and the bottom section here shows how far you are away from your 4-year average, and that's coming down too. So assuming this keeps coming down, this would be positive for economic growth. In particular, what we haven't seen the past few months is investment outside of AI, artificial intelligence. The kind of traditional CapEx has been kind of flat on its back. And I think there's a lot of companies who are just waiting to see where everything shakes out on tariffs before they decide where to put that next plant or next dollar of investment. So as that uncertainty fades, you would expect some of that CapEx to come back. Something to watch. But the main thing to remember here is as uncertainty fades, it tends to be good for the economy and in turn the stock market. Okay, so turning over from the economy, what's going on with earnings? Earnings season, as we're getting through the Q3 earnings season right now, has been very strong on the back of a very strong Q2 earnings season. I think a lot of analysts were overly cautious about the impact of tariffs. They took their estimates way down. Now they're exceeding those expectations. In fact, we're on pace to probably get double-digit earnings growth for 2025, which I think if you talk to many people in April, they'd be pleasantly surprised if that's what we were going to get. Now, with the market having rallied, we're priced to near perfection here. This chart is showing the PE ratio, or price to earnings ratio, for the S&P 500. It's using projected earnings. So even with those optimistic views of earnings going forward now, we're near the highest we've been the past several decades. We were higher during the dot-com bubble. We were also higher in 2020, 2021, coming out of the pandemic. So look, what it means is that when the economy does slow, there probably will be a big correction, probably even a bear market. Whether or not that turns into a huge bubble that pops like in 2000 or what happened in 21 and into 2022, just kind of a normal bear market, probably depends on how crazy sentiment gets and how over exuberant investors are going into that. Right now, as we'll talk about in a minute, it doesn't seem to be like it was in 2000, but it's something to keep an eye on. But right now, I think what we need to take away is we priced in a lot of good news on the earnings front at this point. Doesn't mean that that good news can't come through the next 6-12 months, but there's room for disappointment if for some reason that doesn't. Okay. And I've alluded to artificial intelligence in a few different ways. Here we're kind of look at it from an earnings perspective. So what we're doing here is actually looking at the Mag 7, which is a term for 7 of the biggest stocks in the market. A lot of them are directly in that AI trade. They are collectively over 1/3 of the S&P 500 market cap. So 7 stocks are 1/3 of the market. So they are obviously very important. Now they are 26% of earnings. So they do quote unquote trade at a premium, meaning that their PE ratios are higher than the rest of the market. That's what this bottom section shows. Now it's not as extreme as it was, say, the beginning of this year, or what it was in 2022, 2023. So I think there's some room here for them to continue to outperform, but what they really need is for the earnings growth to come through. for them to justify, their earnings. And because they're such a big part of the market, if those stocks run into any troubles on an earnings front, it's probably going to weigh down the S&P 500 or any market cap weighted index because they're just so critical to the overall market. Okay, so a couple more charts here. One is just from these kind of historical studies are really good antidotes to keep in mind. They're not necessarily, indicators I'd say, well, this means you should definitely do X, Y, or Z, but they just kind of remind you how history has acted, and history doesn't repeat itself, but it does rhyme. So we had a pretty unique situation earlier this year. We had a 10% correction in the S&P, but then by the end of the third quarter, the S&P was actually up 10% on the year. So we're listing all the time that's happened. This is it since 1928. What happened in the fourth quarter, that's what the right-hand column shows. Every time the S&P has been up in the fourth quarter by a median of 7.5% versus the average of 2.7 for all fourth quarters. So these bullish reversals tend to continue through the end of the year. And the last thing here is what's going on with investor sentiment. This is our daily trading sentiment composite. There's about 25 different indicators that go into this. Things you probably see, if you hear Tom Keene on the radio on Bloomberg, he always talks about the VIX. Well, this is in here. Also some surveys of individual and institutional investors. The way you read this is if this orange line is very high, that means there's lots of optimism. The stock markets tend to struggle because everybody who was going to buy probably has. Likewise, a low number means there's lots of pessimism. When there's lots of pessimism, the weak sellers have probably already been shook out of the market. That's what we saw in April. By the time we got to April 8th and 9th, this was eyeing 2018 for the lowest reading we've ever seen on this. You remember 2018 was when Jay Powell was trying to teach the market a lesson that the new Fed chair wasn't going to institute a Fed put and cut just when markets got volatile. And the market taught Jay Powell a lesson that, yes, there is a Fed put, market gets too volatile, and the Fed will have to cut. Ironically, still kind of a single person event here. What happened with the administration in early April, but we got to such an extreme pessimistic level that the next piece of good news was probably going to cause a market rally. And of course, we got that on April 9th with the 90-day pause. But here we are, 30-something record highs in the S&P 500 later, and this is only at neutral. And given the kind of rally we've had, the S&P has risen 35% over 6 months for only like a handful of times post World War II. So I think it's like the fifth or sixth time post World War II had that kind of rally over 6 months. So it's really remarkable. And yet there's still people who are cautious on the economy, on the markets, probably because there's still that uncertainty over tariffs, some fears over the labor market, other things that we've talked about already. But whatever it is, it's causing some investors to not get in, fully in the market. And one more thing on this is that the hedge fund community was caught a little flat-footed coming off of the lows. A lot of them got back in, but not fully. They're not fully levered up the way they normally are. And as we get closer to the end of the year, they're going to be inclined to chase performance, because if they don't outperform, they may lose assets. So they have every incentive to pile on. That's why momentum tends to work toward the end of the year. So every day the market goes up, the more likely it is you're going to see the momentum traders push the market higher, at least through the end of the year. And this sentiment composite implies there's room for that to happen. So you put all together, pretty constructive environment, earnings growth in decent shape. Fed is friendly, inflation unlikely to ratchet up out of control over the near term. Technicals look solid, and investor sentiment is not quite at optimistic level. So we're recommending to our clients to be fully invested. We have an overweight allocation to U.S. stocks relative to bonds and cash. So that's it for me. Patrick,
Wow.
I'll pass it back over to you.
What a great summary, Ed. And, everyone, we're really lucky to have the opportunity to hear from Ed. And, we thank you very much for being on our call tonight. So thank you so much, Ed.
Happy to do it.
Since Ed ended with his thoughts on investor sentiment, that is exactly where I'll start tonight. To piggyback on what Ed just said, Ned Davis's main sentiment indicator is in the neutral zone. Another favorite sentiment indicator of ours is the CNN Fear and Greed Index. It's currently at 39, which is in the fear zone. It's hard to believe that given the fact that markets are hitting all-time highs, there is such a disconnect between what's going on in the economy and how the stock market is reacting to it. Think about the news we're still dealing with. The government is in shutdown mode, and that's currently affecting 670,000 furloughed employees. Many governmental services are on pause. Many companies that service the government are holding their breath as well, hoping the government opens and things get back to normal. The markets are still being yanked around by tariff tweets, good and bad. The advent of AI, artificial intelligence, is causing every industry and business to reevaluate their need for the number of people they employ, and is it possible to provide the same or better service with less people? Of course, we still have the Ukraine and Russian war. In general, there's plenty to worry about from the average investor's point of view. This is why I believe sentiment has still not gotten to extremely overbought, or as we say, overly optimistic levels yet. At some point, we'll get to very overbought levels. We always do, at which time we'll need to adjust our portfolios to a more conservative position. Let me get into what I see going forward for the rest of 2025 and the early part of 2026. I mentioned the benefits of the new tax law that is being played out with so many companies onshoring new plants and equipment here in the US. This will be a very long-term positive for America. On my last quarterly call, I mentioned I thought interest rates would be stable and I thought the US economy was starting to slow. The economy is slowing, as represented by the last two unemployment reports, which showed the number of new jobs created was the lowest in several years. August is the last official report we have from the Bureau of Labor Statistics that showed only 22,000 jobs were created in August. Since the government shut down, we don't have any official numbers for September. ADP, a private payroll company, estimates the number of jobs created for September were actually a loss of 32,000 jobs. This clearly tells us the economy is slowing. I believe this slow data is the main reason the Federal Reserve decided to lower interest rates at their September meeting by 0.25%. With the stable inflation and the government shutdown, the Federal Reserve decided today to lower rates again by 0.25%. If this weak trend in job creation continues, the Federal Reserve will have to continue to lower interest rates until they see an improvement in job growth, while at the same time keeping inflation in check. Remember, the Federal Reserve has two mandates. First, to make sure the employment in the economy is stable, and second, that inflation stays between 2 and 2.5%. Last Friday, we received the delayed CPI report, which stated inflation was running at 3% annually. This was slightly below forecasts and in line with most people's expectations. The good news is, although inflation has been a touch higher, it's still considerably below the levels of 2021 and 2022. As Ed Clissold from Ned Davis showed, inflation is still trending lower. One of the biggest unknowns is what will the final tariffs end up being, and what will the final impact on inflation and corporate profits be? So far, the impact has been much lower than forecast, and companies are finding ways to avoid passing along all of the increases in prices to consumers. Most companies were preparing for the worst when it came to the impact of tariffs on their bottom line. Many companies overcompensated for what they predicted as the potential impact of the tariffs on their bottom lines. Just last week, General Motors mentioned the impact of tariffs was going to be reduced from 4 to 5 billion annually to 3.5 billion to 4.5 billion annually. So they prepared for a higher number, and the number actually is slightly lower than they anticipated. I think this is probably true for many U.S. companies that were trying to predict the total impact of tariffs. Again, as Ed Clissold mentioned, corporate profits have been rising at a double-digit pace so far. This was not what many people thought would be the outcome this year with the impact of tariffs on companies' profitability and earnings. Bottom line, we do not have total clarity as it relates to the impact of tariffs, but we are getting closer to that. President Trump is in Asia this week hoping to finalize a deal with China. That would go a long way to calming the markets and getting clarity concerning the impact of tariffs on corporations' bottom lines. The markets will be watching very closely to see what the final outcome is. If nothing happens, we probably get a little sell-off in the market. But most investors believe it's not a matter of if, it's more a matter of when does a deal get done. This is why the market has not suffered and continues to go higher based on the fact that a deal will ultimately get done. The real question, again, as it relates to tariffs, is this impact on inflation. As I mentioned earlier, last Friday, a skeleton crew of BLS employees reported that the CPI was up 0.3% for the month, and the annualized rate was 3%. They needed this number to be able to calculate and tell senior citizens next year's Social Security payments are now set to go up by 2.8% in 2026. If you remember in April, one of the biggest concerns from the investing community was that what was going to be the impact on tariffs on inflation. I wanted to share a comment I made on our last call because I think it highlights how careful and dangerous listening to the talking heads on TV can be for all of us as investors. In April, I quoted the chief investment officer of a company I will not name, and they said at the time, in 30 to 60 days, we should expect shortages of goods on store shelves. Well, guess what? That did not happen. This is such a perfect example of why you must protect yourself and your investments from so-called experts on TV. The impact has been small compared to what most prognosticators had predicted. Ask yourself, where was the stock market today as compared to April? And it's pretty simple, much higher. As we know, one of the key drivers of the market is the level of interest rates. The Federal Reserve lowered interest rates by 0.25% in September, and they lowered again today. As I mentioned earlier, if job growth continues to stay weak and the government shutdown persists much longer, we will most likely get another interest rate cut in 2025. The shutdown will have a slowing effect on the economy and will force the Fed to cut interest rates further. With lower rates tends to come lower mortgage rates, which in turn help home sales. In the last several months, home sales have been trending at the lowest rates in over a decade. Lower rates help the economy. They help car sales. And again, this then helps so many other areas of the economy when we have more home sales and car sales. So broadly speaking, lower rates are an extremely positive catalyst for higher stock prices generally. In April, the 10-year Treasury was 4.4%. In July, as I mentioned earlier, the rate was 4.42%. Today, the 10-year rate is 3.97%. So the good news is rates are coming down, albeit very slowly. Housing has softened quite a bit, and the inventory of homes on the market and the number of days they are listed before selling has steadily increased over the last year and a half. Housing, including residential housing and housing services, is almost 16 to 18% of the U.S. economy when we measure GDP. So I just want to reiterate that because lower interest rates are very important to new and used home sales, and housing is such a very large slice of the U.S. economy. Now, one of the indicators I mentioned in July that had long-term success is looking at that 50-day moving average versus the 200-day moving average for the S&P 500. It's had a good long-term track record at getting you out of the market before extended drops and getting you in before long up moves. For those listening to the call on their computers, we put up a chart and we have all the data all the way back to 1929. I've updated numbers for you tonight. Since 1929, when the 50-day moving average is above the 200-day moving average, the markets return 9.06%. When the 50-day moving average is below the 200-day moving average, the markets returned 0.59%. On July 1st, the indicator went positive, and again, the S&P 500 was 61.98. Today, the S&P 500 is at 68.90. That's an increase of 11.1% since it went positive July 1st. This is another positive for the stock market. Now, the tariff uncertainty helps to explain the reason gold and many gold stocks have been doing so well as an asset class, the fear of future inflation. Gold was at $3,315 an ounce on our last call. Today, gold is approximately $3,992 an ounce. That's an increase of 20.4% just since our last call. The high on gold was just a week ago at $4,355 an ounce. And gold is up over 50% so far this year after being up 28% last year. After such a good run, gold probably needs to rest for a while. The trend for gold is still clearly higher, but it has become a more popular investment. And whenever that happens, it concerns me when all you hear on financial shows is how is gold doing? Again, I think gold needs a pause for sure at this point in time. Now, as corporate America continues to do well, companies have continued to buy back more and more of their common stock. In the first half of 2025, corporations bought back a record amount of stock, $528 billion worth of common stock. With earnings growing at double digits, I suspect this number will grow in the second half by even a larger amount. We'll get numbers in November on how much was purchased for the third quarter. Buybacks simply reduce the supply of stock that trades in the market. It's that simple theory of supply and demand that takes over. Less supply, more demand, prices should rise. Another amazing fact that supports higher stock prices is the amount of money sitting in money market accounts. At the start of 2023, the amount of money in money market funds was $4.8 trillion. Today, the amount in money markets has swelled by 55% to $7.4 trillion. As interest rates fall and as investors try to decide what to do with those funds now that interest rates are falling, what are they going to do with these funds? Many believe, as I do, that a portion of these funds will go into the stock market. This, along with corporate buybacks, adds to the upward pressure on stock prices. Now, as many companies have started to report earnings for the third quarter, we're hearing from many companies that they are looking at incorporating AI across many parts of the business to become more efficient and profitable. The examples are way too many to share on this call, so I'll share just a few. At Johns Hopkins, they have an AI platform that flags patients for sepsis risk. And this was linked to an 18% reduction in mortality when clinicians acted on alerts quickly. This in real hospitals across hundreds of thousands of patient encounters. This saves thousands of lives. JP Morgan's coin system reviews complex loan agreements in seconds, saving 360,000 hours of lawyer and analyst time every year. Again, that's weeks of manual work compressed into minutes. Visa says AI helped it block 80 million fraudulent transactions worth $40 billion last year. That's protection for the internet. UPS has a system called Orion, which uses AI to redesign driver routes. It saves about 100 million miles of driving, 10 million gallons of fuel every year, worth hundreds of millions of dollars in expense for energy, as well as a big cut in emissions. The last one I'm going to share is John Deere's See and Spray, which uses computer vision to hit only the weeds. Farmers cut the use of non-residual herbicide use by more than 2/3 in the field, which showed that they used 40 to 59% less during a normal growing season. So I could go on and on and on of how AI is going to help us in so many ways, but I wouldn't be talking for hours. I'd end up talking for days, the difference that AI is making in the world. Now I want to look at how has the market performed after we've had such a good first 10 months of the year. Carson Research looked back and found whenever the stock market was up over 15% in the first 10 months of the year, the market went on to go up another average 4.7% in the last 2 months. In fact, the market was only down one time out of 21 occurrences that this happened. That's a 95% accuracy. Of course, I know I say this all the time, past performance doesn't guarantee anything in the future. But that said, those are pretty good percentages. I know I show this chart over and over and over, but there's a reason. Stocks historically have been the best long-term place to invest your money. As many of our long-term clients know, we have long-term experience in the market, something many money managers simply don't have. Our success doesn't happen by luck. It happens because we're disciplined, flexible, and we really do think outside the box. We continue to pride ourselves as independent thinkers, and our satisfaction for our clients is what drives our desire to succeed. As I said in July, the smoke is clearing. Now we can concentrate on what excites me the most. Investing in companies that understand and are utilizing AI and other innovations to succeed in business and become more profitable, that help us live longer, safer, and healthier lives. As I titled tonight's talk, AI Everywhere, this will become more evident every day we move forward as we hear more and more about the advancements AI is making and continue to make. This is so exciting to me. As I said in July, I think this kind of environment is where we have tax law and corporations all in sync to achieve excellent outcomes. The big question I get all the time is, we're at all-time highs, Dan, in the market, and where are we going, and when's this big sell-off coming? And these questions make me think back to December of 1996, when Alan Greenspan, the chairman of the Federal Reserve at the time, gave a famous speech titled Irrational Exuberance. From the time he gave that speech in December of 1996, the stock market doubled by its peak in March of 2000. In 1994, we had the launch of the internet with something called the Netscape Navigator. Everyone said the internet was going to change the world. They could not have been more correct. Today, the big thing is AI. We all hear about it almost every day. Let's look back at how the market did in the late 90s after the internet was starting to become popular. In 1995, the S&P was up 34%. In 1996, 20%. In 1997, 31%. In 1998, up 26%. In 1999, up 19%. The market was up 5 years in a row. Now, I'd never say we're going to be up 5 years in a row, but I want you to see what is possible with a world that has changing new technology like the internet and now, today, AI. AI is really only 2 years old, so to speak. And I know this because I recently had a client tell me he no longer Googles everything. He asks Chat GPT for the answer. So it just goes to show you how quickly things are changing. Of course, no one knows when a big correction is coming. I can tell you we will have a bear market again for sure. But as of right now, let us review the facts on the ground. One, we have a slowing economy and stable to falling interest rates. We have double-digit corporate profits and one of the best corporate tax environments in many years, along with incentives to invest in plant and equipment. We have massive amounts of money in money market funds, and investors are still cautious that a big correction's right around the corner. I haven't even mentioned possible record tax refunds for the middle class early next year, and most likely a new Fed chairman that will be most likely very dovish towards interest rates. I just mentioned how AI is impacting our lives, and it really is just beginning. So the backdrop at the moment is extremely positive for the potential for higher stock prices over the next 3, 6, and 12-month period. Lastly, just stocks had just one of their best 6 months rallies ever, up more than 35% in only 6 months. So yes, near term, we wouldn't be shocked at all if we saw a well-deserved pause in the market after this huge rally and the current 5-month winning streak. But bigger picture, this type of strength isn't what you see at the end of a bull market. Carson Research went back and looked and found there were only 5 times going back to 1950 when the S&P 500 was up more than 35% in 6 months. Stronger than average performance is perfectly normal, they mentioned, coming over the next 12 months. But a year later, stocks have never been lower, and they're higher on average by 13%, which should comfort many of the nervous bulls who think this may be a blow-off top currently. These are exciting times, and until all of our indicators tell us everyone is over-exuberant, we'll stay invested and stay positive towards equities. I look forward to speaking to everyone in January of 2026. I want to thank you all for listening and have a great evening.